What's going on, everybody? Hey, this is Chaz with Churchwell Insurance Agency. Hope you're doing amazing. Hey, man, home officing. It's got its ups and its downs. Literally just had to go and gripe at my daughter a little bit, telling her to turn down the TV that she was blasting in the other room. But our entire agency right now is working remote. Don't know if everybody else is working remote or just out of work. For everybody that's not able to work right now, I just want y'all to know that literally you've been in my prayers, and I hope that the Lord provides and that you're able to figure it all out and that things come together for you. So I want to talk to you about insurance, and if anybody comes up with any questions that you want to talk about, don't hesitate. Go ahead, throw it down in the comments. I'd love to answer any questions that you guys have about insurance. Talking about home, auto, umbrella insurance. If you want to throw life insurance in the mix, I can talk about that. I want to let you know everything that I'm going to tell you talking about insurance is it's not even me. It's not original to me in any way. You're going to find that if you're familiar with a guy named Dave Ramsey, everything that I'm going to advise on is actually what financial guru Dave Ramsey would tell you about insurance. And I want to talk to you about CYA, cover your assets. So again, if you guys have any questions, don't hesitate, throw them down in the comment section, and I'll answer those for you. I want to make sure that I do a great job of that, connecting up with you and answering stuff. So I'm going to start off, just until anybody throws anything in there, I want to talk to you about auto insurance. We'll start off with that. That's the most common one. You're going to find that's where a lot of your biggie claims come from, big losses come from on a lawsuit kind of side of the table. So you're going to find whenever you've got auto insurance, there's really a couple of parts. You've got the part talking about liability coverage, and then you've got the part talking about physical damage coverage. So liability is if you make a mistake, if you're on the hook and somebody gets hurt, liability coverage on your auto insurance is what's going to pay out to the other party. And there's two parts on that. First part is going to be bodily injury, and the second part is physical damage. This is typically the most expensive part of your auto insurance policy, but it's also the most important. And this is the one to where you don't want to cut corners and skimp on it. If you've either worked hard to build wealth or you have a vision for your financial future, the liability section of your auto policy is the part that's going to help you out the most to protect everything that you've worked hard to build, to protect the vision you have for your financial future. This is the part to where if you go out and you get into a wreck and somebody gets hurt really bad, they end up having to get into an ambulance, they go to the hospital, they end up getting sued by you end up getting sued by them because while they're sitting at home recovering from their lawsuit, eating everything that ends in Eatos, chilling on the couch, they see that commercial from that cheesy attorney on TV that says, have you been injured in a wreck? Call us. We'll make them pay. I see you, Kevin Center. Hope you're doing well, man. Blessings. So your liability portion, that's what's going to pay out on that bodily injury and on the physical damage because they're now suing you for medical bills, lost wages, pain and suffering, the fact that their car got busted up. And so what you're going to find is that... Kevin, you got a question? What's up, man? I see you're saying, hey, bro. So I didn't know if you had a question, but we'll keep going. If you do have a question, interrupt me. Let me know. Love to answer it for you. But what you're going to find is that your bodily injury portion, just saying hi. Hey, man. Love you, dude. So you're going to find that... that your bodily injury portion is going to pay out for those lost wages. It's going to pay out for any bodily injury and medical bills that they have involved in the process. And then you're going to find that your physical damage coverage is going to pay to repair their vehicle or replace their vehicle. Here's the problem that you have. In the state of North and South Carolina, it's really low limits, $30,000 per person on bodily injury and a cap amount of $60,000 per accident for like everyone involved that they would cap it at for bodily injury. If you've been to the doctor or a hospital lately, if somebody gets hurt really bad, that's not going to last very long. 30K, 60K, it's not going to take you very far. South Carolina, it's $25,000 per person. In Florida, it's like $10,000 per person on the bodily injury coverage. There's not a lot of protection that's there if you go with the minimum limits. But you watch TV these days and people are so hyper-focused on save money, pay for what you need, like name your price tool, all these kinds of things. But whenever that happens, if you just focus on the price, you end up putting yourself in a really compromising position, because now all they're doing is chipping away and lowering your asset protection. And then you end up really exposed if a bad wreck ever happens and you are at fault. I see Nick Martin on there, brother. I hope you're doing amazing. You want to talk about a guy who sees some bad wrecks. You got a firefighter who's there on the front line. Thanks for everything you do. So what you'll find is, guys, that your liability is the last place you want to cut corners. For example, you can raise your deductible on your collision portion of your auto insurance policy, go from $500 to $1,000. If you're somebody who never gets into a wreck, why are you buying down a deductible that you never use? So you raise up that deductible, maybe you save $100, $200, $300, $400 on your collision deductible by raising it from $500 to $1,000 or from $250 to $1,000, and then you take that other money that you're saving and you move it over to raise your liability protection that you have, so that you're going from $30,000 to $50,000, or from $50,000 to $100,000, or up to $250,000 per person, $500,000 per accident. And today's litigious society, where everybody's just suing everybody and bad wrecks are getting really big payouts. Dave Ramsey, financial guru, New York Times bestseller over and over, #1 financial radio program on the waves today. He will tell you that you should never have less than $250,000 per person, $500,000 per accident on your bodily injury coverage. So just keeping in mind that that's kind of where he would recommend that you start at and going up from there. But a lot of people, their limits, go look up what your limits are. Look it up online, pull up your app, look at the paper you have in a filing cabinet, check it out. You might be surprised that your limits are lower than what they really should be. So again, Dave Ramsey says you should have $250,000 per person as a minimum, $500,000 per accident. And then on your property damage, you would have $100,000 of coverage. And this is just the liability section, because think about it. You can take on $500 extra exposure on your collision coverage and save some money, and move that over to pay so that you can save yourself potentially tens of thousands or hundreds of thousands of dollars if you end up in a bad accident where it was your fault. You made a mistake, right? And so I would tell you guys, make sure that if you need to trim some fat somewhere, let's talk about that. On the physical damage side, we'll move away from the liability and talk about the physical damage part. This is your collision coverage, comprehensive coverage, extended transportation, med pay, or PIP coverage, depending on what state you're in, and then your roadside assistance. I'll dive into those a little bit in detail so you can know what they actually are. So you're going to find that for your Greg, Suzanne, hope you're doing amazing, guys. Blessings to you. So we've talked about the liability coverage. Let's talk about physical damage coverage. And if any of you have any questions, don't hesitate to step in and just ask questions about home, auto, or life insurance. So want to let you know that the big thing is this. You've got collision coverage that's if you hit an inanimate object. So let's say you hit a tire in the road. I can't tell you how many people have talked to me and they've been teed off whenever they found out that the insurance company is going to hit them for a collision because they hit a tire in the road or a pothole. But if you hit an inanimate object, the insurance company is going to nail you for a collision, an at-fault accident. That's going to go under your collision coverage and your collision deductible. If you have anything else going on, let's say we're talking fire, we're talking flood, vandalism, theft. If you hit a deer or a gator, depending on what part of the country you're in, you're going to find that if you have those kind of things, hail damage, that's all going to be under your comprehensive or other than collision coverage. It could be named different things depending on which company you're with. And so your comp or other than collision coverage, you'll find that usually it's exponentially cheaper than your collision coverage is. It's actually one to where you can move your deductible down pretty low. You can have it around $100, something like that. And you'll see that if you move the dial from $500 to $100 on your comprehensive coverage, it hardly changes your price, and it minimizes the out-of-pocket that you have as a client. Collision's going to move the dial a lot. Comprehensive doesn't. And here's the crazy thing about that. Collision is the one to where you just don't have a lot to do with it. You know, if something happens to where you've got to go off the road, whatever, it's out of your control. You end up hitting something. You hit a pothole, hit a tire, whatever. You can't help it. But in most cases, if you're a good defensive driver, you can go 10, 20, 30 years without ever having a wreck, especially an at-fault accident. But on comprehensive, the one that's the cheap one, that's the stuff that's out of your control. That's your flood, your fire, your theft, your vandalism, hail damage, things like that. If you hit an animal that's an animated object, those are the things to where it's the cheap one, and it's the one that's really out of your control if you're a great driver. So you can keep that deductible lower, and if you do have to pay out due to an out-of-control circumstance, it's worth it to dive in on that one and make that deductible lower. Collision goes higher. And then let's talk about the next thing, which is extended transportation expense, ETE, or rental car coverage. This is the coverage to where if your car goes in the shop for a covered claim, your rental car company is going to go ahead and provide you coverage, and they're going to give you a car, and the insurance company is going to pick up the tab. So here's the scoop. You're going to find on that, there's two factors that you really want to know. Number one is it's typically reasonably priced, but at the end of the day, if you work from home and your spouse doesn't work from home, or if you have an extra car, things like that, this is a coverage that most people don't even think about, and their agent doesn't take the time to advise them on. This is a coverage you can, a lot of times, if you want to like trim some fat off your insurance policy, cut that coverage off of there. If you know that you and your wife could get away with one car for a couple of weeks, remove that coverage off there. Save yourself $30 a year, $50 a year, something like that, whatever you're paying for it. And that's just little by little, you're trimming some fat on there. And if you need to, if your limits on your asset protection, on your liability are too low, take that and move it over there so you can actually improve your levels of asset protection and bump that up to where it should be. Or just put some money back in your pocket, right? So here's what you'll find. That's extended transportation expense as what it is for a coverage on the first part of it. But here's the other thing that a lot of people don't think about. Depending on what company you're with, if you ever need to go and get a rental car, everybody's like, oh yeah, I got insurance. I'll go get a rental car. I don't need to, I can decline what the rental car is offering me because my insurance will pick up the tab. In a lot of cases, yeah, but there's one area that's kind of gray, and it actually bounces from company to company to company on how they handle this. Loss of use coverage is going to determine whether or not your insurance company, for some of the companies, not all of them, for some of the companies, it's going to determine whether or not your insurance company is actually going to pay for what's called loss of use on that rental car. If you get into a wreck or the car gets damaged to where it's now out of service, and the insurance company's saying, hey, we can't make any money on this car right now because it's out of commission, they're going to charge you the maximum rate that they could get for that car every single day. And they're going to take their sweet time on getting it fixed, because instead of it sitting in a parking lot, not making them money, they know they can be hitting you for it day after day after day until they get around to fixing it. And you get nailed for hundreds and hundreds of dollars on this. It happens to people all the time. But if you have loss of use coverage on your car, this is going to be the one item to where if you're traveling and you're renting, your loss of use coverage is the one thing that can actually make sure that if that car is out of commission, you don't end up getting drilled by the rental car company whenever they're trying to come back and say, hey, we can't rent this car out and make money on it because it's damaged, so you're on the hook. If you've got an insurance company that actually provides loss of use coverage, then you're going to find that rental car coverage that you paid to have on your auto policy, most of the time, you'll want to talk to your agent about it, but with most companies, that's going to extend over. Will Khalil, what's up, brother? I hope you're doing amazing. That's going to extend over, and that's actually going to protect you so that you don't end up getting drilled by the rental car company if your car is out of commission because of something that happened while you were driving it. So that can be a substantial deal that's on there if you're somebody that uses rental cars a lot. Next thing is just roadside assistance. I'm going to tell you, most people don't know this. If you use roadside assistance, it's cheap on an auto policy. It really is. But I have people that they'll have an older model car. They'll use their roadside assistance 3, 4 times, 5 times over a stretch of 5 years. Here's what people don't know. Every time you file a claim, anytime your insurance company pays money, they're counting that as a claim against you. People all the time, they're like, roadside assistance? That's a claim against me? I'm like, yeah. Anytime the insurance company's paying money out of their pocket for you, they're counting that as a claim against you. It's a small claim. It might only be $70 for what they actually pay out, but then they're processing it on the back end with their people. So it ends up being $150 to $200 out of their pocket, but they are going to tier you and they are going to rate you and count that as a claim against you. And so you always want to be mindful of that. A lot of times, if you have older model cars and you know that you might count on that roadside assistance, then the reality is you're probably better off going and getting AAA to make sure that you can mitigate and keep your insurance down low if you're going to be using a decent amount of roadside. Then the last thing I want to talk to you about is called personal injury protection, or PIP, depending on what state you're in, or MedPay if you're in a different state. So MedPay and PIP, again, like I've told you guys a couple of times now, I'm giving you recommendations by the #1 financial guru for books and on radio, Dave Ramsey, on what he suggests on this. And Dave is going to tell you if you've got your uninsured motorist coverage, if you've got your health insurance policy, and if you have disability coverage, long-term disability coverage, and if you've got an emergency fund, which you should have, Dave is going to tell you that you should forego MedPay and PIP, or PIP, personal injury protection. He's going to tell you that if you're allowed to skate off of that in your state, you should do so. It is one of the most profitable line items in the insurance industry. So if it's the most profitable line item in the insurance industry for auto, then what you should know is that you're probably not going to get any money off of it. 70% of people will never use MedPay or PIP coverage to actually be able to recoup off of that. And so if there's only a 30% shot, why are you going to pay out hundreds of dollars on that every year if you've got multiple cars, multiple drivers? So cut the MedPay coverage off of there if you've got it. Again, trim the fat, put more money back into your pocket, investing it, raising your asset protection limits on your liability, whatever you need to do. So in a nutshell, guys, that's auto insurance. You've got your liability section and you've got your physical damage section. On your physical damage section, that's the nickel and dime stuff, right? That's the stuff to where it might cost you $500 more if you file a claim or whatever. But then you've got your liability section. That's the part you want to really focus on, because Dave Ramsey will tell you, insure and protect against the catastrophic loss. You've either busted your butt, you've built wealth, and now you need to protect your assets, protect everything you've worked hard to build, or you need to factor in that you've got a vision for your financial future. Because if you get sued by somebody for $300,000 and you've only got $30,000 of liability coverage, that's $270,000 and you're in the red. What are you going to do with that? That's one of those things that'll make you throw your hands up in the air and say, crap, I can't get over that hurdle. And so they can put liens against your house. They can garnish wages, all these different things. If you've got secondary investment properties, they can force the liquidation of those and different assets that you have to try to be able to recoup some of those costs. They'll basically take you back down to zero with the exception of your IRA and 401k or 403b. You'll get crushed financially. So make sure you insure against the catastrophic loss. It's better to take $500 extra on the chin than to take $50,000 extra on the chin. So just wanted to be mindful about that. That's auto insurance. Let me know if you've got any questions on that. You can type it in the comments. I'll answer them. Otherwise, I'm going to flip over and we'll start talking about home insurance and just really helping you guys out. Hopefully, some of y'all that are home officing, you're not going too crazy right now. I know that I just needed to unplug. We've got a ton of people talking to us about coronavirus and how that impacts their businesses and everything of that nature. So I just needed to unplug from that for a minute and figured I'll talk to you guys about this. So here's the other thing, home insurance. Let's talk about that. You're going to find that you've got two major parts on homeowner insurance. When you get your packet in the mail, that thing is 30 to 40 pages thick. But the most important thing that you want to pay attention to in there, it's always good to read all of it, But the most important thing you want to pay attention to in there is called your declaration page. This is the meat and potatoes that's going to tell you this is what we're paying for coverage A, which is your dwelling, coverage B, which is going to be your other structures. Your other structures are going to be like if you've got a detached swimming pool, a fence, a she shed, if you've got a workshop out back, a detached garage, maybe you've got an outdoor kitchen or pergola that's detached. That's all other structures. You want to make sure. I can't tell you how many people that I see that they do things to where they'll build stuff out in their backyard and they never bother to tell their insurance company. Your other structures coverage, you're typically going to get 10% of whatever your dwelling amount is. $500,000 house, $50,000 on your other structures coverage, okay? But if you go out and put a $100,000 pool in your backyard and you put another $50,000 guest house, pool house right attached to it, that's $150K, but you've only got $100,000 or $50,000 on that. You're not properly protected there. You got to talk to your agent about them and then let them advise you on those kind of things. You're going to see that you've got coverage C, which is your contents. It's your stuff that you have in your house, you know? Basically, if you took your house and flipped it upside down, everything that fell to the ceiling, April Jones, what's up? Hope you're doing amazing. If your contents coverage, take your house, flip it upside down. Everything that falls to the ceiling, that's your contents, that's your stuff. If you've got a built-in refrigerator, like a Sub-Zero, Viking, whatever, you're gonna find that's not considered personal property. That's gonna be part of your dwelling because it's literally built in and screwed in. But same thing with the dishwasher, you know, it's built in under your countertop. But let's say that you've got a slide-in fridge or a slide-in stove. If you took the house and flipped it upside down, it's gonna fall to the ceiling, right? So that is actually personal property, as opposed to being part of your dwelling. So you'll find that most companies are gonna give you a default amount of 70% of your dwelling amount on your personal property coverage. But here's the reality. Depending on the price of your dwelling, the cost of your home, you may not need that much. And a lot of people don't even know you can talk to your agent about bringing that down. I've got some people that they're like, hey, you know, I've got $150,000 of coverage, or I've got $300,000 of coverage on my stuff. Why aren't you quoting me for that amount? And I'm like, well, do you have $300,000 worth of stuff in your house? Like if you had to go out and buy everything again, do you think it would cost you $300,000? Well, no. Well, how much do you think I should have? I'm like, well, let's talk about it. Are you, the way I put it to my clients is I ask them, are you Prada, Puma, or Payless? Like when you go shopping, kind of what do you fit into, you know? And we dialogue about it and kind of talk about the quality of goods that they buy. Obviously, if you are somebody who has means for a $500,000 plus house, you're probably buying some finer furnishings and putting in your home than somebody who lives in a $150,000 house. It's not to be crass or anything like that. It's just kind of a common generality of what you would have for expectation. One person is shopping at Big Lots, the other person's shopping at Pottery Barn or Crate and Barrel. So you just want to make sure that you bring that number down or bring that number up to whatever you need it to be. A lot of people don't know that number is actually flexible and it can move up or down. So you can either save some money or move it up to have better asset protection. So going down from there, you've got another coverage called loss of use. Loss of use coverage is going to be huge because of the fact that I have a client right now. Their house burned to the ground and they are displaced, and it's going to take probably about 14 months for everything to be settled out, debris to be cleared off the land, and for them to reconstruct this house. 14 months. They've got to go, and they're being placed into a furnished home on a short-term lease, and it's going to position them in a place to where it's going to cost a lot of money. Their rent on this house is going to run about $5,000 a month. So their loss of use coverage, because they had a very nice home, large home, $60,000 just for 1 year, right? $70,000 for for 14 months. So you're looking at, if you lose use of your home, your loss of use coverage is what you want to make sure that you've really got about a year to a year and a half of coverage that's going to be there, of what it would cost for you to be in a short-term rental place, because this is going to cover any expense associated with it. If you're in hotels temporarily, if you're having to eat out a lot more while you're in hotels because you don't get to be in your home eating food there, all these different kind of things. That's your loss of use coverage. Again, any extra expense you incur as a loss of use because you've lost use of your home. So let's jump down from there to MedPay. Jump from there to liability coverage. So liability coverage is massive. If anybody ever comes over to your house and they sue you because of something that they think you are at fault on, or if you are anywhere else in the world, internationally, and somebody sues you because of something that you are personally liable for. I didn't say in a business capacity. That's an exclusion on the policy. But let's say that you're traveling from Texas to North Carolina and you've got your dog with you and your dog bites somebody. It's not at your house, but that dog was in your personal care. So you are liable for the fact that your dog bit somebody, and they are most likely going to sue you, and they are going to win. They are going to win big. So here's the reality. Your insurance company is going to have to pay out on that, and because there's going to be a lawsuit associated with it. And whenever they pay out, that's going to happen off of your liability policy. So coverage will extend beyond where your house is if someone sues you for something you're personally liable for. But it's also if somebody slips and falls on your sidewalk and they sue you, or random stuff like, imagine you have a contractor in your house and they literally fall off of a ladder in your house. I've seen people get sued because a contractor got hurt at their home and the contractor said, "I'm suing you." And your insurance is going to defend you in court and pay out if necessary. That's what your liability coverage is. Here's the wild thing. Most people don't realize this. On most homeowner policies, the difference between $300,000 of general liability asset protection and $500,000 of general liability asset protection is usually only $4 a year. $4 to jump $200,000 extra of asset protection. It's huge. So there's no reason that, unless you are in a state like Florida to where certain carriers cap the amount of liability you're allowed to have, there's no reason why you shouldn't have that $500K. So make sure that you're putting $500,000 on that policy. And then the next thing down is MedPay. MedPay is what allows friends to stay friends. If you come over to my house and let's say that you scratch up against a sharp corner that I have in my home, we actually have a metal dining room table, and so it's wood legs, but it's actually stainless steel of some kind, and there's corners that are on there. Let's say over time those corners were to ever get really sharp and somebody rakes against it, slices their leg open, needs stitches, and they're like, "Chaz, it's your fault. I need to go get stitches. I need you to pay for that. You're on the hook." And that's whenever you get to say, "You know what, man, that's why I have home insurance, and that's why we have MedPay. No worries." It allows them to not have to sue you to be able to actually get access to that medical payment coverage. Insurance companies literally have it there to avoid a lawsuit. So that's what your MedPay coverage is. And then if you go down from there, you'll find that you're going to have really just a lot of these ancillary endorsements that you can put onto your policy. A couple of them that I'll tell you that are really huge is you'll have something called loss assessment coverage. Loss assessment coverage is massive. From the perspective of, I can tell you that one neighborhood that I know they got hit really bad by Hurricane Florence in North Carolina. It's a community called Landfall. They didn't have enough insurance to actually cover all of the damage that happened to them, and they ended up experiencing a lot of losses that they're now actually going to be passing on to their HOA members, to all of the residents. So there is going to be a massive assessment that's going against them. So you've got this loss assessment coverage that's there to help protect you if something like that ends up happening that can be helpful to you. You're going to find another endorsement that you want to make sure that you consider having on there is water backup coverage. I'll let you know in my agency, we do not write homeowner insurance policies without water backup coverage. And the reason why we don't do that is because it is such a common loss. If you ever have any pipe in your house that ever has water that backs up, overflows, and causes water damage, a friend throws a wet wipe down the toilet, backs up, overflows. You may or may not know your dishwasher shares a drain with your disposal. Let's say all that gunk gets backed up and then all of a sudden you leave, run the dishwasher, and that backs up, overflows. You've got something called a P-trap that runs off of your HVAC unit, and it drips condensation out the side of your house from your air conditioner all summer long. We see those that get built up with calcium lime deposit all the time. Let's say that thing backs up and you end up having water that's just dripping and finding the path of least resistance. And I've got one of my friends, Steve Provost, that's mocking me for having my hat on backwards. I see you, Steve. It's all right. I'm just keeping it professional, man. It's home office day, you know? Hashtag coronavirus, right? Everybody's home officing now. Don't judge me. Don't judge me. So what you'll find is that P-trap, if it gets clogged, water backs up, and we literally we've had this happen to so many of our clients to where it finds the path of least resistance, and before you even know it, you've got a pond basically built up under your hardwood floors, and everything has to get ripped out and redone. And here's the crazy thing: if you don't have water backup coverage, you have zero coverage on your homeowner policy. Another thing that some of the companies are starting to do is they're starting to add on a flood endorsement that you can put on to some of your policies in certain states, which is a really cool deal. But I'll tell you that you may or may not know this. No homeowner insurance policy has flood insurance built into it. I get my heart broken so many times a year when I have people who have a basement that call me and they're saying, hey, water's coming through our basement walls. I have people that call me and say, hey, because of the rain, water is permeating in through our building because it came up above the foundation. Hey, Chaz, we have damage from this, we have damage from that, and it's all about rising water seepage through walls. And the reality is this: that's going to be constituted as flood. And if you want coverage for something like that, you need to talk about a flood insurance policy. And I want you to know, you can endorse flood insurance onto some companies. They're starting to do it. It's this trend that's starting to kick in, and some of them are doing it to where you can pick up like $50,000 of coverage on your house for like $70. But another thing that's really important to know is that if you just want flood insurance, you can have $100,000 on your stuff and $250,000 on your structure if you're inside of what's called Flood Zone X, which you may think, oh, I'm not in a flood zone. Everybody's in a flood zone. Everybody is in a flood zone, whether it's the lowest risk or a higher risk. And so you're going to find that if you're in Flood Zone X, which is the lowest rated flood zone, you can have flood insurance for like $38 a month. You got to pay it in full for the year, but it equates out to $38 a month. And then, of course, if you have escrow, you can float into your escrow after the first year and kind of roll with that. So that's flood. I wanted to make sure we got that in there and talked about it. And then one last thing I'm going to mention. There's a bunch of different endorsements that you can add on to your policy. Actually, I'll mention two more. I'm going to talk to you about scheduled property. So a lot of people think, okay, if you're insuring all my stuff for hundreds of thousands of dollars, that means you're insuring all my stuff. All my stuff is good, right? So here's the reality. Insurance companies they're smart. You know, they've been doing this for a really long time. They know that there are categories of items that are more likely to be stolen from your home, you know, and things like that. So you're going to find that you actually have certain categories to where there's going to be cap limits. So for example, you're going to talk about jewelry, fine art, fine china, flatware, musical equipment, firearms, antiques, collectibles, sports memorabilia, things like that. You're going to find you actually have cap sublimits that for most of those items I just rattled off are really pretty low. So for example, let's say that your wife has a wedding ring, engagement ring, whatever, that's $10,000, $15,000, $20,000, $30,000. Let's say that she's got a pair of earrings that are another $6,000. Let's say that you've got a nice timepiece, gentlemen. You know, you've got a $5,000 tag, $9,000 Breitling or something like that. You're going to find that that your insurance policy, depending on what company you're with and depending on what policy form you get written on, will, in most cases, have $1,500 to $2,500 of coverage, but you can have up to, if you have a specific type of policy form, up to $5,000 of coverage that's just built in on the policy. And this is not per item. I'm talking about all of it. So if you've got $20,000, $30,000, $40,000, $50,000 of jewelry in your home, you may only have coverage for $1,500 in the event of a certain loss. So there's something called scheduling property. And the most common thing to get scheduled in jewelry is going to be a wedding ring or engagement ring, like that's going to be your big jewelry item. And so you may want to talk to your agent. I'd love to be that guy if I'm not that guy, with Churchwell Insurance Agency, about being able to actually have coverage to properly protect your assets on there. Again, CYA, cover your assets. So you'll find that you can have it with a $0 to $100 deductible, something like that. And then it covers it if it gets broken, if it gets lost, if it gets stolen. I'll give you a personal story. Shortly after my wife and I had gotten married, we had taken her ring in. It was kind of a specialty setting. It needed to get pulled apart to get cleaned on the main stone. In order to do that, they literally had to pull the center stone out. They get in there, clean it, give it back to us. My wife takes it, you get it fresh back from the jeweler. You're kind of like flicking it because it's all nice and sparkly, fresh out of the jeweler. And she goes, oh, my diamond's cracked. You guys cracked it. And it became a he said, she said thing. K Jewelers would not own the fact that they had cracked it. And we couldn't prove that it was cracked that it wasn't cracked before we had given it to them. So it was one of those things where we just kind of threw our hands up and said, okay, I guess I'm claiming it on insurance. So cool deal out of all of that was this. We claimed it on insurance. We made enough money off of it because it was based off of the appraisal and not the purchase price. We made enough money to where we were actually able to go get my wife a bigger, better diamond, new diamond ring, and have enough money for an all-expense paid trip to Key West. It was pretty nice. Key West, Waldorf, Astoria. The Waldorf Reach. It was pretty good. So I throw that to you, but then I also want to tell you about another thing, because keep in mind that can happen for musical equipment, all these other different things. So let us know if you have any scheduled property we need to talk about. But then there's one final thing that I want to make sure that you guys know about. Replacement cost. Making sure that you have enough coverage that's on there. I see my mom watching. Hey mom, love you. Want to make sure that you have enough coverage. So this is going to cover two things. Number one, we're going to talk about an endorsement that you add on there, but it also is going to encompass the dwelling amount. That very first thing we talked about, your dwelling coverage. So you want to make sure that you understand that your insurance for your home is not supposed to be about covering how much you paid for it or how much the house cost to build. You want to actually have an insurance professional that you can trust do a cost replacement estimate. It's often called an RCE, or replacement cost calculator estimate. So here's the thing on that. I see it happen all of the time to where somebody will come back to me, Chaz, man, I love you, but you got to do something on this price. I've got another agent that I let quote me out, and he's coming in $700 cheaper than you. Man, would you mind sharing that quote with me? They'll share the quote with me, and I'm like, man, they've got your dwelling coverage in there way less than what I've got it in there. Is there any way you could ask them to share the cost to rebuild calculator that they did? And they'll go back, ask the agent for it. Agent sends it over. They'll have a 3-car garage, brick house, all that kind of stuff. And what you'll find is that their 4,000 square foot beautiful home with a basement and all these other kind of things, they'll say that it's on a slab instead of a basement. They'll say that it's a 1-car garage or no car garage. They'll say it's vinyl siding instead of brick. And I'm like, man, you got 4,000 square feet, right? Yeah. Okay. You got a basement, right? Yeah. Well, these guys are saying that you've got 3,100 square feet, that you're on a slab, that you've got a 1-car garage, and that you've got vinyl siding. We're not looking at apples to apples. And then they're like, holy crap. And the reality is this: your insurance company, they're not going to overpay. They're going to rebuild the type of home that you had. And so that gets into one other thing that I want to talk about. some agents will try to skate, and they will put in there and they will cut all those corners, but then they'll pad it by using an endorsement called Additional Coverage A replacement cost. This is a number designed to pad up and build your dwelling amount in the event of a complete loss, to where there's not enough money to actually cover the loss. But what a lot of people don't realize, or they just ignore as agents, is this. If I have a $500,000 house, let's say I have a $750,000 house, and it's only insured for $500,000. But then the agent goes on and they put on that 150% guaranteed replacement cost endorsement. If it's just a normal circumstance and there's a total loss on that home, there's not extenuating circumstances as far as scales of economy, supply and demand, catastrophic events like a hurricane to where contractors are price gouging because they can, things like that, you're going to find that these people are, these insurance companies, they're not going to give you 150%. They're not going to give you $750,000. They're going to say, man, we'll give you the full amount you had insured if you can go build all of that 4,000 square feet, brick, basement, 3-car garage for the $500K, back with the finishes that you want. Great, but we're going to give you the $500K because you signed and disclosed to us that this is what you had and that this was the adequate coverage for you. Your 150%, your 125% guaranteed extra replacement cost is for extenuating circumstances. Like, for example, if you're in a coastal region, or if you're in a region that's prone to tornadoes, things like that, to where there's large loss events. Harold, what's up, brother? I see you on there. Hope you're having an amazing day. So you're going to find that is designed to be there in extenuating circumstances. Let's say that, for example, Bernie Sanders was to make a miraculous, somehow crazy comeback, and he ends up winning and becoming president of the United States. He wants to overnight go from $7 and whatever it is for minimum wage up to $15 an hour. That means your artists and contractors that work for anywhere between $18 an hour and $25 an hour, those guys are not working for $18 to $25 an hour anymore. You now are going to want to tack an extra $7 to $8 on top of that. That means you're looking at 50 to 30% extra to rebuild your home on labor costs. And so you could have this all of a sudden extenuating circumstance of rebuild cost on a home. That could get factored in there to where you would have that money. Or let's say that there's a hurricane event that ends up causing to where now there's price gouging by contractors. That's the kind of thing that could use that additional replacement cost on your home. But just in a normal temperature, a normal climate, they're not going to allow you to cut corners on your cost to save money and then try to come back and use that extra to pad it in the end. I've seen a lot of agents that try to cut corners and they try to misrepresent and be like, oh yeah, you can do that. So be careful if an agent tries to say, we can underinsure you and then use this on there to build it back up to where it needs to be, because that's false. And it could end up biting you in a claims process down the road. So that's going to be everything for homeowners insurance. And the last piece that you want to talk about on there is deductible. What's up, Harold? Getting schooled, man, getting schooled. I'll tell you, hey, go back and watch this. I'm teaching everybody how to cover their assets. I don't even know how long this video has been going on, but I'm talking in depth about everything you need to know for all of your main categories on home, on auto insurance, and I'll even talk about here in just one moment an umbrella. So last thing I want to talk to you about is this, deductible. I'm going to let you know kind of sweet spots. So there's 2 deductibles. If you're in a coastal area, you're going to find that you have something called a wind and hail deductible. If you're not in a coastal area, then you're just going to have 1 deductible. But if you're coastal, you have 2 deductibles. One is your wind and hail, and one is your all other peril, otherwise known as your AOP deductible. And so what you're going to find is that I got a cat over here grabbing a highlighter, trying to have a conversation, and it's distracting me. Sorry about that. So your deductibles, I want to let you know this. You want to make sure that you don't keep your deductible too low, but don't raise it too high. I know people who have lower cost to rebuild homes, under $300,000, and they'll have $2,500 deductibles or $2,500 deductibles on their all other peril coverage. If your home is over $300,000 to $340,000, I'm going to let you know that if you look at the probability of you filing a claim over the next 7 years, next 10 years, it's decent. Whereas you're probably in a position to where if you do the math on that, it's not worth it to have the $2,500 deductible. Have a $1,000 deductible instead. But you're going to notice that after you cross over about $340,000 on the cost to rebuild on your home, it becomes advantageous to go up to a $2,500 deductible and self-insure a little bit more there. You'll see the savings is going to be much, much better at that point. Additionally, let's say that you've got a wind and hail deductible. I'll tell you, a lot of people, wind and hail, you're going to see that there's two different things, and some people get confused on it. You want to either have a 1% deductible, 2% deductible. I'll tell you that in North Carolina, 1% is usually going to be pretty normal for you. South Carolina, Florida, Georgia, 2% on your wind and hail is going to be is pretty standard, and it's reasonable. You're going to find that what you want to focus on there is just kind of looking at it. If you're under, again, if you're under about $340,000, $350,000, go for a 1% deductible. If you're over that price, you may want to explore a 2% deductible. And here's what that percentage thing means. So let's say that you've got a $500,000 house, just kind of keeping with a nice round number. 1% of 500,000, it's $5,000. That means your deductible is going to be $5,000 in the event of a wind or hail loss. That means anything that is going to be the originating cause is associated with wind or hail, $5,000. Now, there's one other way that, depending on how things get written out for you and depending on what state you're in, you'll see that sometimes they'll actually say named storm deductible instead of wind and hail. A named storm deductible, you can play with those a little bit and see kind of how things fare out. But a named storm deductible is actually a more expensive deductible than wind and hail. What that means is this. If there's ever a named storm, Hurricane Dorian, Hurricane Flo, Hurricane Michael, Hurricane Ivan, all these things, those are named storms, tropical storm, blah, blah, blah. Anytime a named storm hits, if you had a named storm deductible instead of a wind and hail deductible, that means that you would pay that higher deductible, that $5,000 in that event. But let's say that you have a named storm deductible instead of a wind and hail deductible. And then let's just say a normal storm blows through. Nothing particular, but it's got some nasty wind with it, lightning with it, whatever, and there's some hail damage that comes out of that storm. What you're going to find is that you actually get to pay the lower deductible. You get to pay your all other peril deductible instead of your named storm deductible because it wasn't a named storm. And so, because the storm that came through, it was just a storm line. It didn't have a name associated with it. So there's no named storm deductible. You just pay your lower $1,000 deductible or $2,500 deductible on that. So that's everything for home. That's everything for auto. Now, the final thing I'm going to talk to you about is just putting a nice little bow on it. Umbrella insurance. Umbrella insurance. Dave Ramsey will tell you that this is the cheapest insurance money can buy. So if you've got $500,000 asset protection on your home, if you've got at least $250,000 per person, $500,000 per accident on liability for your auto, we've talked about both of those things, then that is the qualifier that allows you to get something called an umbrella policy that you can lay over on top of all of your personal liability exposures. This includes if you've got rental houses, put it under there. Boats, put it under there. Motorcycles, put it under there. They all go under this umbrella. And what you'll find is that you can have $1 million or $2 million of asset protection. If you've just got a home and an auto, husband, wife, 2 cars, your normal $1 million of asset protection to go above and beyond what you have on your underlying stuff is going to cost you like $170 to $200 a year for $1 million of asset protection. I believe everybody should have it to protect everything that they're working hard to build or have worked hard to build. But particularly if you ever get to where your net worth is over $250,000, it's really a must-have. I believe that everybody should have it. Again, hear me on that. But if there's ever a fatality, I want you to think if you're in a wreck and somebody passes away, then what you're going to find is that you're in a position, guys, to where to where you need to be aware that that could be $1 million lawsuit and it could ruin you financially. But if you have an umbrella, that could be the difference between financial ruin and having peace that you took care of things and did it the right way. So that's it. If anybody has any questions, my email is chaz@churchwellagency.com, CHAZ @Churchwell, like go to church, do it well, agency.com. Want to let you guys know that our agency website, churchwellagency.com, and our agency phone number is 844-604-1357. And we'd be honored to work hard protecting everything that you guys are working hard to build, personal lines, commercial lines, anything. Harold, I know if you're still watching, we love electricians. We crush it. We'd love to get some contractors in there and restaurants and gyms. Those are our sweet spots. Hey, blessings to you guys. Have an amazing day. Keep up that social distancing. #social distancing. All the best. Bye.